All right. Good morning, everybody. First thing we want to do, take a look at what happened overnight. Make sure there's nothing going on around the world that would directly affect our markets or even that can explain the moves that we happen to wake up to in the morning. One good free source for this is Koifin. It used to be 100% free. Now they run some mixed paid version, but even with signing in on the free account, you can still see that global overnight perspective. Not too much news standing out across the top. Nothing that really would drive markets. But you don't know until you look. So it's just the first thing you want to do. Go in and take a look. What happened around the world? Is there anything standing out? If you subscribe to anything like Bloomberg or Wall Street Journal or anything like that, if there's anything really big that everybody is talking about, then it wouldn't matter where you go. That's going to be the headline, right? Like when Russia invaded, it didn't matter what news source you went to. Even just turning on your browser would show, the little news articles, and it stood out. So if there's anything really big, airplanes falling out of the sky, whacking Boeing's stock price, whatever it happens to be, you just want to take a glance, take a look around, see if there's anything that really stands out. From that, we come into Market Watch, kind of ask the question, what's on the agenda for today? Only the additional auctions, right? So at 11 and 1, we have those additional auctions. They're worth noting what time of day. And tomorrow is the big one. Tomorrow is the CPI. The market is really waiting on this. This is the one, right? So it's the game changer for the rest of the week. I would not be surprised at all to see a market just kind of maintain position until tomorrow when we get this. All right. We have a lot of speakers today. Williams, Bossack, Misers, and Bossack again. And the president is going to be speaking today as well. And then there also is a bar chart webinar being hosted at the Bullish Bears today. So there's that as well. All right. So bar chart is sending somebody over. They're going to have a webinar presentation with us, kind of explain their product, show us how they use it. And I believe they're also going to offer some discounted rate, but I don't know. I haven't been the one setting it up or speaking to them. Just if you're interested in checking that out, be in the Discord at 2. Yeah. All right, so the expectations for today, really keep your eye on the clock. When these guys are talking, they can say things that rock the market, right? So as usual, 3 things that we can do. Stay sideways, break to the upside, break to the downside. The sideways range is worth looking at from multiple points of view. Sideways could be from our own Globex low to our own Globex high. That would be considered the range. But there's more range than that. You can look at the Globex low that we have this morning all the way up to yesterday's highest value. This would almost encompass and let's just move it over a little bit. Yesterday's lowest point to yesterday's highest point. If we're inside of that, then we are inside day, right? So that would yet again be a range. 2 different ranges, But the first range is basically sitting inside the second range. So, looking at it from that point of view, it's just one big range. That would be the range thesis. And it's not off the table. It's very likely that that is going to be our day. Just holding or maintaining the line, not falling lower, but not really rallying out of that box. We can rally out of the box. So if that's our first scenario, what's the second one? Well, the second one would be that we leave the box to the upside. Since we're in a little bit of a dead cat bounce right now, that's not an unrealistic assumption. With that in mind, an upside breakout, we would first have to get through our own Globex high, through yesterday's open, through yesterday's Globex low, and then through the Sunday night open, Sunday night into Monday Globex high, and then we would be outside of it, right? Which is this green line all the way up there at 4,100. That would be our upside expectation, and we would have to get that far just to get outside of yesterday's range. So if we're talking about breaking the range from our current location, we would need a move greater than 2.1%, right? We're already up 0.7, so you're looking at nearly a close to a 3% move in the S&P to be above 4,100 by the end of the day. It's possible. It's absolutely possible. It is doable. I think that all of these pivots that we would hit along the way is very likely going to stop us from doing that, right? So while it's possible and it's on the table, I don't subscribe to that. The third scenario would be that we break to the downside. We would first need to leave our own expected move. Got all these pivot points in the way. So yesterday's close, yesterday's open back into Globex, the lowest point of yesterday, the Globex low of today. All of those would be pivot points that we would expect to run into. And then beyond that, a move to the downside. And we would first give back that 7.7% that we already have. Just getting to the Globex low, we would be down from our current location 1.3%. Well, we're up 0.7. So we're looking at, we'd be down 0.6, right? More than a half of a percent into the negative just to get back down to 39.61. So below that, then we'd start moving into something that is a lot closer to our ADR levels. So game that out from where we closed. Just a 2% move to the downside would put us at 39.11. That's the cog line. As you can see, we're really far outside of the box. Looks like we are now attempting to come back towards the box or to get back towards the middle. For us to do that, we have to make it through the volume shelf or this volume node, high volume area around the cog line 40.11. If we can get through that zone and hold above it, which we got there last night, we just weren't able to keep it, faded back down. But if we can get back above that, then the expectation is that we'll begin moving towards the box and get back inside the box. Notice that pivot point at 40.55 has no real volume node to it, right? So we can snap a line there and say, okay, it set a low here. When we came back and interacted with it, price responded. There's nothing really there though. So, we want to draw the line, look at it, but it's a minor pivot. It doesn't have a lot of weight. Don't lean on it like a handrail. Don't expect that thing to provide a lot of context. It's a minor pivot. Pivot minors, pivot majors. So, you can mark it, but I wouldn't give it a lot of love, a lot of trust. That's at 40.56. The 10-day point of control is at 41.50. Kind of feel like that's a little out of our reach, but it is doable. Looks like Williams is out there chipping his teeth already. I see financial juice lighten up. He's saying things that's making the machine turn red. Very likely going to start seeing some response from the things that he's talking about. So looking at a 5-day, 5-minute chart, what we call mapping out the 5x5, we do not have a virgin POC from yesterday, but we do still have one from Friday. So, just reaching up and marking the point of control from Friday in the expectation that should we come up to that area, then there's likely going to be a response from the market when we get to that place. I kind of think it's out of our reach unless one of these Fed members happens to, really spur this happy overnight giddy feeling. If we're already at 0.7 and that line is 2.6, so you're looking at like a 3.3. Well, we've got an ADR right now of a 2.6. So I'd say we'd have to break the ADR and then add nearly close to another 1% to be able to hit that line. So it's doable, a little unrealistic, especially when all of these major pivot points are in the way. Keep in mind, we don't want to use phrases like, well, it can't, right? We don't want to say it can't move that far because that's not true. Price can do whatever the heck price wants to do. We want to approach it from a point of view that says it's not very likely, right? Or it's improbable that it's going to move that far. I will add, by the way, if we do start to get into an extreme upside move, you're going to see it in everything. Tick, trend, ADU, vol, market breadth will be lit up. Cumulative tick, trend, everything, right? The sectors are going to be lit. The fangs are going to be lit. It won't be subtle. If we're going to make that kind of move today, it'll be all up in your business. Anywhere you look, everything's going to be running to the upside. It'll be that kind of day. And that's not what we have right now, right? So things would have to change from its current situation. For the Nasdaq, kind of got the same situation. The box is a little bit bigger, but we've got our own Globex range, and then we've got the range from yesterday's highest Globex point to yesterday's lowest value. That's a really good size box. There's every expectation that we just maintain that, right? That we have a range bound day sitting inside of yesterday's price action. Notice, since it's such a really big box, we can have very clean, very beautiful, very wonderful price action. It doesn't have to be choppy just because we're inside yesterday's range. Having said that, however, most of the time when you're sitting inside of yesterday's range, it's a choppy day. We can still trade it. So I'm not telling you, that you can't trade it or that you shouldn't trade it or that it's untradeable. It's tradable, and it's a really wide range. So there's an expectation that even within that range, could have some nice price action. Outside of that alternative, if we should break outside of yesterday's high, we would first need to get through a couple of pivot points first. Our own Globex high, the open of the RTH yesterday, the Globex low of yesterday, the RTH high of yesterday, Sunday night open, Sunday night high, Friday's 5 o'clock close, Friday's 4 o'clock close, right? All of those are over our head to be dealt with. And there's very likely going to be a response out of the market at every one of those locations. So it's going to be an uphill battle to make it through every one of those. The only way conceivable that I see we would make a kind of move like that and not have the battle is if one of these Fed speakers galvanize the market into like a blow off top scenario or a massive impulse play where we just get really large candles like this, only they would be green instead of red, and they would just blast through all of those pivot points. All right, so downside play. We would have to get through the close, the low of yesterday, and then the Globex low before beginning to break lower and start getting into some very old price action from a year, maybe 2 years. Remember that something that far back, especially when you're looking at futures, isn't going to provide a lot of weight because those futures products have expired, right? They're gone. They're off the board. It's not like stock that we could point to and say, well, there was a liquidation here, or there was a lot of, previous volume. There's nothing like that. Even the concepts of like anchored VWAP and those kind of things, they're off the table. There is some price consolidation around that area, that 11,888. And so, in theory, there is something there. I wouldn't lean on it or trust it at all. Just kind of recognize that it's there. You'd be better off using your quant tools, your drawing tools, Fibonacci lines, and running it intraday through each pivot lower rather than trying to find some higher time frame signal to sit on. There is an untouched point of control from Friday if we're looking at the 5x5. So it's worth noting where it is if we get that upside move, but it's so far away. I just find it really unlikely we would be able to even get to such a thing. Again, without some serious news, and it wouldn't be subtle. We would run that way like it'd be like lightning. Everything would be lit up. Right, so looking at the volume profile, it's worth noting how narrow this thing still is. Between the value area high and the value area low, we're still in a very, very narrow volume profile. It's also worth noting that we're very, very far outside of the box, right? We can use very a lot. Very, 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 very. We're outside the box, and we're outside the box by a long ways. When we get this far outside of the box, the expectation is that we get back in the box, that we begin moving in that direction to at least attempt to get back inside the box. If from our current location we continue to move farther away from the box, that is significant. It's statistically significant. It has weight behind it. It would be impressive. It takes a lot of transactions to continue to keep us moving farther away from that box. There is some volume, a high volume node that we're interacting with literally while I'm talking. right around the 12.3 area. If that's basically our last line of support, that little volume node. And I wouldn't lean on it. I wouldn't give it a lot of trust. But if we break that, we're very likely going to retest the lows of 12.1 area. And there's no other volume profile down there to help us out. To the upside, there's no volume over our head that we have to deal with, no kind of volume resistance to be concerned about. So, it's a clear shot back towards the point of control or back towards the volume profile, other than the near term pivots that I'd already pointed out here in the lower time frame. Notice the market maker move this morning on the Nasdaq. So while we have our regular ADR of 3.7, today we have an additional market maker move of nearly 1%. So the Nasdaq has the capacity today to make nearly a 5% move, for 4.7% move, and it wouldn't be considered an outsized or an extreme move. Just kind of ponder on that a little bit. We're talking about looking at the Nasdaq make a nearly 5% move and shrug and say, yeah, no, that wasn't that bad. It was within its means. It was within its expected move. That's big. Yeah. ES does not have the market maker move this morning, just the Nasdaq. Nah. All right, a little micro double bottom in energy last night. The VIX has come back off of that 35 level. The dollar still maintaining its range from yesterday, but the moves in the dollar is kind of what gets my attention. Big sweeping moves in both directions. Definitely a two-sided market, no argument on that. But after all that running around like a hamster on the wheel, it's right back where it started about 24 hours ago. It did a whole lot of nothing. The bonds, on the other hand, seem to be continuing that move back up, or at least it's certainly trying to reclaim some levels. It got really beat down, and I don't like to use language like overbought and oversold, but yeah, that thing was down far enough that you had almost no other expectation than the idea that it would start to pull back. But I think it's going to be a quintessential dead cat bounce in its beautiful, most basic, classic form. I don't think that this rally in the bonds is anything more than a pullback before its continuation lower. Time will tell. For today, it doesn't matter. The main thing we need to focus on today is it going to break this Globex high and make a continuation to the upside, or are we going to revisit those lows from yesterday? These three charts, although in the current market, not so much the VIX, the dollar and the bonds, these two are the game changers on the day. They're your validation, your confirmation, your assistance and signals. If you're trading anything out there, but especially the S&P and the Nasdaq, whether you're doing that through the S&P, SPY, SPX, ES, MES, NQ, QQQ, NDX, any approach, this kind of grid or this kind of setup would help you a lot, because these markets are not independent. They're not moving on their own. They're moving in a group, in a set, and they're a part of the outlying larger market perspective. There are times when you can get heads up because you notice it happening somewhere else first. A massive liquidation in the dollar, or a massive spike in the dollar, a big move in the bonds. Even if you don't quite know what that's going to do to your market, just seeing the dollar or the bonds begin to make an exaggerated move in one direction is often a tell, a great heads up, a warning at the very least to watch out or to jump in, because it's giving you the confirmation you're looking for. Like in this very tight consolidation last night when we opened back up in Globex and the bonds were pressing against those highs, and we had that nice breakdown in the S&P, and we had this nice breakout in the bonds. Now the bonds were showing a very clear pattern, right? There was a really, really clean setup here. The S&P didn't have very much of a clean setup. We were just kind of range bound. We've just gotten back open again, kind of laissez-faire, not really doing much. But this was a nice clean top. So it stood out. It was an easy thing to recognize. Now, did we know it was going to make the move that it made? No, of course not. You know, you got to play the probabilities. There's no guarantees to anything. But when you can validate and confirm or get just a little more signal out of the market, hey, you want to take it, right? In the Globex, you don't have tick, trend, AD, U-Vol, and all the other things, but you still have the bonds, and you still have the dollar, the gold, energy, Bitcoin. So tools that can still help. Yeah, Frank, I got the ADR by using a custom indicator called ADR. That custom indicator is in the Discord where all the custom indicators are at. Got over 1,000 of them. So it's labeled ADR, MMM, and ATR. If you don't have any of those custom things and you want to know what the ADR is, you can use ATR, which is kind of close. It's close enough, right? Wink and a nod. So just go to the ATR on a daily chart. I've got my ADR set to a 21, so you could set your ATR to a 21 and just kind of ask the question, what's the ATR right now? $459. 459 points, right? Because if we weren't on a futures product, then it would be dollars instead of points. That's a daily move, averaged over the last 14 days. Could have swore I set that thing to 21. There we go. ADR, ATR, right? Close enough. ATR has weightings in it. It uses an average true range, whereas ADR is more like the same mathematics that you would use in a simple moving average, right? There's no weightings. So for today, guys, the idea that we could have a dead cat bounce in all of the fun names is very likely, right? At least it was on the table until the Fed started talking this morning, and now it's a little more squishy, but definitely possible. So you can see, Tesla, Amazon, Microsoft, Apple, Nvidia, they all had that rally, starting to get that rally, and now they're all kind of getting soft and giving it all back. Remember, the Fed's goal right now is to teach everybody to quit buying the dip, stop buying the dip, stop buying the dip. So for every rally we get, it's like sell the rip, not buy the dip. They've been calling in the team and just giving the smackdown every time we start to get any sort of a rally. Okay. Today would be no different. And then there is the expectation that nothing has changed. There is no reason for this upside move in the marketplace other than how far the S&P and the Nasdaq had already made moves to the downside. A dead cat bounce is nothing more than the pullback before the continuation into the next leg lower, right? The way a market generally works with a trend. You get the pullback and then you get the trend, you get the pullback and the trend, the pullback and the trend. So the pullback, dead cat bounce. It's basically where we're asking the question, is this just a pullback or is this a change in market sentiment? Notice the SPX is outside of the weekly expected move, and we hit the edge of the expected move on Monday. Got a lot of different trade strategies that are fully automatic. And one of those automatic trade strategies says if you hit the edge of the expected move on a Monday or a Tuesday, take the trade in the other direction. It will win more than it loses. And I literally had someone ask me yesterday why I would use such a strategy, because it doesn't work all the time. So if you're a new trader and you think that there is some strategy out there that works all the time, change your perspective, because there is no such thing. You can give up on that hunt. But going long, opposite of whatever edge we hit, or going short, right? If we hit the top, go short. If we hit the bottom, go long. If we hit that edge on a Monday or a Tuesday, take the other side of the trade. It wins more than it loses. You don't have to take my word for this either, and every market is different. But you can put the indicator on and you can start counting back. Did it hit the edge on a Monday or a Tuesday? And just start looking. We hit it there, it would have failed, right? That one, we still closed outside the box. So that one didn't work. Keep going backwards, keep going backwards. Here we hit the edge on a Monday or a Tuesday. We closed inside the box. Although, I mean, it's arguable. We could argue that it was right on the edge. Maybe it failed. Statistically speaking, when we hit the edge of the expected move on a Monday or a Tuesday, take the other side. It wins more than it loses. Now, having said that, I've got a lot of videos on this indicator. I have taught a lot of different strategies on this indicator. And one thing that's really important to recognize about the weekly expected move is that in high volatility conditions, markets break their expected move. They break their expected move a lot. Volatility is another word for movement. It's just a really fancy word for movement. And when you have implied volatility, then you have an expectation of greater movement. Price is very, very likely going to break its expected move in a high volatility environment, because that's what it does. That's the promise. So pre-COVID, way before we had any idea that such a thing even existed, when times were good and the market was just running in a nice, clean, orderly, trending pattern, look at how often we even touched the edge of the box, let alone went outside of it. It was rare times. Then we got really violent, really volatile right before COVID hit. I actually made a video the week of this week right there. I made a video talking about the expected move, and that happened the next week. And in that video on that day, we had 5 weeks. So 1, 2, 3, 4. I guess it was right in here. All of those weeks, there was misses. We were breaking outside and closing outside of the box over and over, week after week. And I warned people in that video, this is a warning. When you're breaking outside of the expected move and closing outside of it that frequently, something's wrong. Why are the market makers so far off in their projections? Why is price breaking outside of this thing and closing outside of it so far away? And then what happened? COVID. That COVID didn't sneak up on us. It was already out. There was news agencies talking about this thing right into the new year, all the way up until this hit. The market started pricing in danger, started pricing in risk. Volatility was not reflecting that danger. The market maker move was, the edge of the expected move was, price was. So look at the current market environment. And even with this, we still close inside the box more than we don't. And when we hit the edge on a Monday or Tuesday, take the other side of the trade. It will win more than it loses. Simple as that. So if we hit the edge on a Monday or Tuesday, go long. If we hit the upper edge on a Monday or Tuesday, go short. I wouldn't do it with calls and puts. I would do it with a spread, something that says all you have to do is stay above this line, right? It's a lot easier to have a trade that says, I bet you won't go lower than this, than to have a trade that says, I need you to go this far. When you buy a call, you need price to go somewhere or you're going to lose. Same thing with a put. You need price to travel or you're going to lose. But with a credit spread, you don't need price to travel. You just need price to not come and hit you. It's that simple. There's also the idea that in high volatility environments, you probably want to approach any strategy that's using expected move with caution. So going long on the edges on a Monday or a Tuesday in an environment that looks like this, it's a high risk situation. You're just begging for a loss because you're attempting to trade in a high volatility environment with no regard whatsoever for the violent nature of the current market conditions. I've got two minds on this market today. One is that we're going to get a 30-minute to a 45-minute rally at the open, and then it will roll over and dump on our heads and continue the move to the downside. I don't have anything that I can point to that would say that we're going to get a move like that, but that would be my first inclination. We will know more when we get closer to the open. One of the things that I'm going to be looking for is how far away from the Globex high are we? And if we open underneath this current 403 Globex high, if we open up underneath that and a considerable distance, say $3 on the SPY, within that green line here at 400 flat and 403, if we open up closer to that green line than the red one, the expectation that I'm going to have is that we're going to hit that red one and then continue to dump. And we're going to have a nice little 30-minute rally, and then it just crashes on us. It can prove me wrong, and I'll be happy about it, but that's going to be my current expectation. I won't trade that blindly, by the way, and I wouldn't expect any of you to do that either. Let it actually give you something to trade. All right, we're looking at the S&P 500. We want to change this to pre-market. Use the filter because I don't want 500 names. Just want something around 100 names. 90 is about as close as we can get. Got to adjust the color scheme a little bit. Otherwise, things that are up like 0.44% still are not changing the color scheme, right? Look at Walmart. It's up a considerable amount. It's still gray. So hit where it says +1 and move that down to 0.1%. And now you can see the color scheme is a little more responsive, and even Walmart has color to it this morning, right? As long as it's above 0.05 or below 0.05, it'll have color. So just a little bit of a color scheme. You can see the fangs stand out. They're the big boxes. Google, Microsoft, Apple, Tesla, NVIDIA. The argument could be made that Facebook is still in it, but definitely not Netflix, right? I think it's lost its standing. You can see that healthcare stands out. And some of the chip names. When it comes to the S&P, it has financials, and the Nasdaq 100 does not. So for all of these FANG names that are up at least 1%, they're going to be a large part of my focus. Looking for that flip in those to continue the run, to continue running them to the downside, especially the ones that have not been beat down as much, right? Something like Facebook, I'm not too interested in trying to go after Facebook to the downside. It's already been beat down pretty hard. Now, if it's got an opportunity to trade, yeah, sure, why not? Otherwise, I'm going to continue to focus my longer term swing trades against the other FANG names that have not made the drop. On the intraday, the day trades have still been financials and energy. You know, companies less than, say, $75, really liquid options, uh, nice betas, good move on the day, plenty of move on the day. So from the S&P, you want to take a look at the Nasdaq 100. Again, we want to change the color scheme, make it a little more responsive. Pre-market change percent. We don't need a filter because it's already 100 names. There's no financials in here. We can see health, just like in the S&P. Health is the weak one today, negative. Some chip names, if you're looking at peers of the chip industry, things like Texas Instruments, but not just that one, right? Kind of dig down the list. The chips are softer, a little squishy. And if we look at companies that have weekly options, which is what this list is focused on, there's not very many names that are red this morning. It's easier to look at this list at the opposite of what it's doing, right? Because this list is like 600 names. So I can scroll and scroll and scroll and scroll, and we can see all these green names. Or I can just look at in the entire list, how many are red? Not very many at all. And for the ones that are red, they're extreme for the most part. Down considerably, 6%, 12%, 15, 22, 33%. These are extreme negative markets. So the things that are down this morning are really, really down this morning. Otherwise, we've got a few that are flat, and everything else is at least 0.5% to the upside or better. So in the Nasdaq 100, how many names are up at least 1%? 31. That's not too bad. 31% of the Nasdaq is up at least 1%. For the S&P, 20. Yeah, I mean, it's not bad. I'd like to see that number improve a little bit. This kind of helps give a little more weight to my idea that we're going to have kind of a reasonably decent open and that it'll roll over and dump down on us. Of course, like I said, the Fed is talking today. They do run the narrative. If they want this thing to sell off, they'll say whatever they got to say to spook people and get them to start selling again. If they think we're sold down enough, then they'll activate that plunge protection team. That's not just a phrase, by the way, it's a real thing. They'll activate that. They'll all go out into the media and say things that get people buying. I used to think things like the plunge protection team had something to do with actual algorithms going in and getting the machines to trade certain things. And that was a misguided conception, right? It was a misguided idea. It was when I was much newer to the market and I didn't grasp the logic of things. They don't have to go in and trade anything. All they got to do is go out there and chip their teeth, right? They can imply things as their position gives them the authority to do, and the market will start pricing that in and selling into it or buying into it. That's all they have to do. So an activation of the plunge protection team to see this thing bid up through the day would be nothing more than seeing the Fed speakers today go out and say positive things that galvanize this market into a rally. It's that easy. And I'll leave you guys with that. Have a good morning. Be careful. Be safe. And hopefully I see you guys at the webinar today, 2 o'clock in the main chat room.